Chapter 1. The first screen. The number on your screen is $92,431,000. Not your money, not even close. You're just the one who has to make it make sense. It's 12:18 a.m. The office lights are dim, but never off. Your laptop fan hums like it's breathing. The Excel model in front of you has 14 tabs, and at least 3 of them are wrong. You know this because the outputs don't reconcile. They never reconcile the first time. You fix one assumption. Revenue growth drops by 0.7%. The valuation falls by $18 million. You pause. You stare at the screen long enough for your coffee to go cold. Somewhere in the building, a managing director is closing a deal that will generate more money in fees than your entire family has made in their lifetime. You're not jealous. Not yet. Right now, you're just trying to make line 432 equal line 433. You tell yourself something everyone here tells themselves. This is where it starts. Everyone in this tower started somewhere like this. Excel models, cold coffee, late nights. You are learning how the machine works. Chapter 2. The language of deals. 2 years later, you speak a different language. Not English. Deal language. Words like leverage, EBITDA, covenant flexibility, equity upside. They slide out of conversations like normal vocabulary. You are now an associate. Your base salary doubled. Your hours didn't change. You still stay until midnight 3 nights a week. But now you sit in the conference room during calls. You don't talk much. You observe. A CEO of a manufacturing company explains why his margins dropped last quarter. Your managing director nods like he understands. After the call, he leans back and says one sentence. "We can buy them cheaper now." That sentence becomes a $1.2 billion acquisition strategy. You realize something quietly. The numbers matter, but the interpretation of the numbers matters more. Anyone can read a spreadsheet. Very few people can weaponize it. You begin learning how. Chapter 3. First deal. Your first real deal closes when you are 27 years old, a $480 million acquisition of a logistics company. You worked on it for 5 months. You built the model. You updated the pitch book. You ran sensitivity scenarios at 3 a.m. the night before the board meeting. When the deal closes, the press release lists exactly 3 names. None of them are yours. You receive an email from HR. Subject line, spot bonus. Amount, $12,500. You stare at the number longer than you expected. It feels large. It also feels strangely small compared to the $9 million advisory fee the firm collected. That's the moment something subtle changes inside your head. You stop measuring money the way normal people do. You start measuring percentages of deals. Chapter 4. Vice President. At 30, your title becomes Vice President. The promotion email is 3 sentences long. Your responsibilities expand overnight. You now manage analysts. They look exactly the way you used to look. Tired, ambitious, slightly nervous around senior staff. You know their schedule without asking. You know they will stay until 1 a.m. fixing models. You also know they are watching you carefully because you represent something important. Proof that the system works. You now run smaller deals yourself, middle market transactions, private placements, strategic advisory mandates. Nothing glamorous, but enough to understand the mechanics of power. Deals are rarely won because of superior analysis. Deals are won because someone trusts you enough to call first. Trust in this industry is not emotional, it is transactional memory. Who solved the problem last time? Who picked up the phone? Who closed when things became difficult? Your job becomes simple. Be that person. Chapter 5. The Quiet Compromise. Every career here contains one moment. The moment where theory meets reality. For you, it happens during a $700 million acquisition. Your client wants to buy a competitor. The numbers look optimistic. Very optimistic. Your model shows the synergy projections are aggressive. Aggressive enough that the acquisition might struggle. You bring it up once in a meeting. Your managing director nods politely. Then he changes the topic. Later, he says something quietly while walking back to the office. The client wants the deal. That sentence ends the conversation. The deal closes 2 months later. Your firm collects $14 million in fees. 18 months later, the company announces layoffs. You feel something briefly, then it fades, because you finally understand the unspoken rule. Your job is not to decide whether deals happen. Your job is to decide how they happen. Chapter 6. Managing Director. At 36, your title becomes Managing Director. Everything changes, and nothing changes. Your salary is no longer the main number. Your bonus is. Some years, it is $900,000. One year, it is $3.4 million. But the real change is not the money. It is access. CEOs return your calls. Private equity partners invite you to dinners. Sovereign wealth funds schedule meetings months in advance. You no longer build models. You build relationships that quietly determine where billions of dollars move. A pension fund needs infrastructure exposure. You know 3 firms who can structure it. A company wants to go private. You know which funds have dry powder. Deals start with conversations now, and those conversations start with you. Chapter 7. Private Equity. Eventually you leave the bank. Not because you failed, because you succeeded. A private equity firm managing $18 billion offers you a partner role. You accept. Your job changes from advising capital to deploying capital. You now sit on boards. You vote on acquisitions. You decide when companies expand, restructure, or sell. One of your portfolio companies employs 11,000 people. You have never visited most of their offices. You approve a $2.6 billion leveraged buyout of a healthcare network. Debt covers 62% of the purchase price. The model says efficiency improvements will increase profitability. Efficiency improvements often mean something simple: fewer employees. When layoffs happen, the CEO delivers the announcement. You attend the board meeting afterward. The discussion focuses on margin improvement. Language in finance is precise. It is also protective. Chapter 8. The Macro View. Years pass. Your perspective expands beyond companies. You begin thinking about entire markets, currencies, interest rates, government debt. Capital at scale behaves differently. A $50 million trade is an investment. A $5 billion trade is a signal. When large funds reposition capital, markets move, sometimes subtly, sometimes dramatically. You learn how to read signals before they become headlines. Central bank language shifts. Bond yields move. Commodity futures adjust. Individually, these changes look small. Together, they form patterns that predict where capital will go next. You start positioning before others notice the pattern, not because you have secret information, because you finally understand the structure underneath the market.